Welcome to TechTO Quick Takes. I'm your host, Alex Reilly, and here are today's headlines. Another purchase we're certain is a positive one. Did too many companies go public on the TSX during the tech boom? We'll get into that. We take a look at how the Canadian banks rank in the Evident AI Index, and a raise that we find particularly interesting that we also want to dive into at the end. So to help me break it down, as usual, Alex Norman joins me. How are you?
Great. How are you, Alex?
I'm doing great. Quite a variety of things we want to talk about today. And just because there are 4 important things we want to get to, I say we just get right into it. So might have revealed a little bit about what we're going to talk about with this headline, just with what I had mentioned. So, a purchase we're certain about and something we want to talk about. So just before we get into this acquisition, if you could just high level share what this is about.
Victoria-based Certn announced that it acquired Slovakia-based Trustmatic.
And so just now that we know kind of what the story is here, why did they decide to make this acquisition?
Well, in the past, we've always said there's several different there's like 3 or 4 fundamental reasons you make an acquisition. In this case, it appears to be product/technology acquisition. As Certn stated that Trustmatic's identity verification technology suite will enhance its offering and better enable it to provide fast and easy identification services. In particular, Certn said these products will be coveted by its financial services customers. What Trustmatic does, it has a suite of products that include identity document reading and authentication, face liveness detection, and biometrics. And so basically what you have here is you can acquire for distribution, you can acquire for sometimes capital, but this seems to be Certn decided that they would like to add this. It could be they could build it or they could buy it, and they decided to buy the technology and the product.
Mm-hmm. And just to go into the buy versus build, which seems, to be the kind of acquisition that we're talking about here, but is there another reason why something like this would benefit Certn and, make this purchase also worthwhile for them?
So, when any startup looks at its product roadmap, there has to be rational for it. We'll get back to it in a second.
Mm-hmm.
And then when it looks at how do we build something, or how do we get this product, these features or product into our suite of offerings, they can say we can build it in-house, we can hire engineers, we can figure it out, or we can buy it and then integrate it. In this case, they said to buy it. And so why would you want to add these suite of products?
Yeah.
They're making the investment to either increase their share of wallet with current customers. So they say, hey, we've got like X% of the potential business we can have with this customer. So we can now, but by adding this product, we can go from X to X plus Y. Or we can improve our conversion of customers in the pipeline. Hey, without this feature set, there's a good chance competitor ABC beats us, and so we don't convert. So you add these features to either capture more money from your customers or get new customers to convert. The quantity of dollars that this produces in revenue to be a winner depends on what they paid. So like if this adds $5 million of revenue a year and 90% gross margin, is that a great investment? It depends what the cost acquired is, which it wasn't very clearly identified how much I paid for this. The flip side here, Certn seems to be building an acquisition muscle, as this is the 4th acquisition they have done. So it seems like they're starting to understand how to do acquisitions, how to implement them, and how to value them and basically benefit from them.
Right. And just from what you shared, just lastly, it seems that it's a win for Certn, but on the flip side, do you also feel that this is, a win and benefiting equally Trustmatic in the same way?
Again, without knowing all the details about the acquisition and how much companies raise, it's hard to tell. But from the outside in, I think it may be. The company was founded in 2020 and seems to only raised 400,000 euros in outside financing. To see the product more deployed more widely is always a great feeling, and there should be financial upside when all you raise is 400,000. I may be wrong, but from the outside in, I imagine there's some type of win. It's not a fund maker, it's not a get retired acquisition, but I imagine investors and founders and the company did okay.
And just last question for you around this. So as we kind of wind down the year, it is still nice to obviously be talking about acquisition news, but is there anything that we should be highlighting maybe as we close out the year related to this news, and anything that our community could take away or take with them into 2024?
So I'm going to make a prediction, this feels like going back to the past prediction we probably made at the end of 2022 or mid 2022. This feels like a preview of what we're going to see in 2024. It's probably taking us longer to get there, but I think a few leading tech companies that have capital, cachet, and the ability in a stock that's still very valuable will acquire technology and customers as companies are funded in early 2020s are forced to sell due to tough fundraising environment. I think lots of companies have postponed their sell or postponed the wind down by cutting employees, raising prices of what they sell to the current customer, so they take the SaaS price and double it, and extending runway with hope that by early 2024 or mid 2024 the funding environment will be better. It is better than it was last year at this time. It's still not great. So I think we're going to see a lot of companies that get acquired by the winners.
I'll have to make a note of this because it might be interesting to revisit this maybe in end of Q1 or beginning of Q2 in 2024 and just see maybe how the prediction has panned out. So we're talking about did too many tech companies go public on the TSX during the boom? So we know there was a hot period in tech. What is the news, I guess, that we want to start or address first before we get into that?
A week ago today, it was announced that Sumero Equity was buying out Q4 for $257 million.
And just what does that mean? And specifically around Q4.
So Q4 was one of the companies that went public in the early 2020s on the TSX. It will now be delisted and privately held. Public shareholders will be bought out and no longer be able to invest directly in Q4. Depending on an investor's entry point, they may present a great or horrible outcome. The acquisition price is a 36% premium to the valuation just before the announcement, but 50% less than the IPO price when the company went public.
And I'm always just curious, like, why, I guess, would they agree to this kind of deal?
Being a publicly listed company comes with significant overhead, time-wise and cost-wise, right? So you have to prepare your docs, you have to talk to shareholders, you have auditors. It makes it difficult to invest for the long run as many shareholders only care about the current and next quarterly results. And it's even tougher for a company under $1 billion valuation because the best way to have patience from your shareholders is to have institutional shareholders that understand what you're doing. And the number of institutional investors that invest in companies that are worth less than $1 billion is quite small. So here you are putting all this time trying to please the market on a quarterly basis, and it costs you money and time. Going private allows the company to focus on long-term outcomes and hopefully invest in a way that creates a stronger and more valuable company that is possible at being public. Roughly, you see a bit of the insider investors voting with their actions. 34% of the current Q4 shareholders are rolling over their shares into the private company. This means they will not sell and only benefit when the company goes public again, is purchased, or issues a large dividend.
And so just in terms of, like, is this something that could potentially be a trend that we're going to be seeing more of? Because obviously a lot of tech companies did go public on the TSX during the boom, and obviously Q4 is not the only one to delist. So is this a trend or something we'd be seeing more?
Well, it's hard, first of all, in TSX, let's look at the TSX. During this boom, about 20 companies went public, tech companies. And what's interesting, Q4 is the sixth one to delist. Prior to Q4, 2 others were acquired below their IPO price. 2 more went private, 1 above and 1 below its IPO price. And 1 voluntarily delisted from TXS because it was no longer meeting the listing requirements. All of these companies faced significant headwinds as tech company valuations have fallen since the boom. It may be the case that the companies have more support as private companies than public companies. So basically, it looks like if you were a company that went public and benefited from these huge valuation multiples and you didn't grow into them, and you probably have a huge incentive to go private right now. And so I think we'll see more and more companies go private over the next little while.
Yeah. And just lastly, I'm sure there's a few things that you'd want to point out here in terms of impacts on like our community and our ecosystem. So what is the overall impact, in your opinion, on our ecosystem?
So this is a reminder, like NASDAQ has run up a lot in 2023, but the recovery really has been limited to mega cap tech companies. Likewise, in the private market, most of the gains have been with a handful of AI companies, including OpenAI, which could be a whole other discussion after this weekend. And as long as the public markets remain cool to tech companies that are in a smaller range and multiples remain compressed, it will put a chilling effect on late stage rounds of valuations. And as startups need to focus growth and capital efficiency, will need to focus on growth and capital efficiency. It's not clear where valuations are heading,
Okay.
despite the enthusiasm for AI and slowing interest rates hikes. So basically, the main takeaway is things are better than last year, but it's still a lot of headwinds in raising
Right.
valuations. I think it's easier now to raise a pre-seed and seed than it was a year ago, but
Hmm.
the A rounds and B rounds and C rounds are still very difficult because the public markets have not fully recovered or for anything but the big seven.
Right. And it's kind of what you mentioned at the end of the first headline too. It's better than where we were last year at this time, but obviously it's still not where we would want to see it. This one was really interesting because I know there's a lot of mixed feelings and conversations around just the Canadian banks in general. So it was interesting to see how they ranked on the Evident AI index. So before, again, I get you to talk about that. What's the news overall, and just, high level, how did the big Canadian banks
So
do?
first of all, it's not news we normally cover, but I thought it was quite
Mhm.
interesting for our ecosystem.
Yeah.
So this company called Evident AI created an index to rank a bunch of Fortune 500 companies, and it does it for every different part of the industry. They just released a banking one for global banks, and Canadian banks scored pretty high. RBC was ranked third in the world with strong showings from TD at 11th, BMO at 16th, and Scotiabank at 18th. So you have four of our big five banks were in the top 20 globally for an AI index.
And I know you kind of touched on what the Evident AI index is, but I guess related to banks, like how were they assessing them? Like what was, I guess, the importance of
So
this?
right from their website, the Evident AI Index assesses the various approaches businesses are taking towards AI readiness, starting with banks. The
Mhm.
November 2023 index covers 50 of the largest banks in North America, Europe, and Asia. Each bank is assessed on 100 plus individual indicators drawn from millions of publicly available data points specific to four pillars: talent, innovation, leadership, and transparency.
And I mean, from my perspective, 11th, 16th, and 18th are all seem to be very good rankings and a win overall for Canadian banks. Why do you think that they ranked so well? Was it
Well,
adoption of, perhaps AI? Was it
so if you
growth?
look at the four categories, you can see the
Different here.
rankings in each one. Sorry to
Hmm.
interrupt.
That's
Um,
okay.
Across the board, these four banks ranked higher in innovation, which
Okay.
says research, patents, venture, and ecosystem, and transparency. So that's like sharing what they're doing and being clear, while
Hmm.
lagging in talent and leadership.
And I know I kind of prefaced this at the beginning when I introed. There's a lot of negative conversation I find around Canadian banks and the banking system in general here. Do you think that this ranking, will, I guess, like help change the conversation around the banking system? Do you agree with this?
So yes and no.
Okay.
Like, look, as Canadians, we spend a lot of time complaining about our banking system,
Yeah.
and there's a lot of people complaining about our overall inability to commercialize the technology we create.
Hmm.
So it's great to see our financial institutions take advantage of our ecosystem and
Yep.
our AI research leadership to drive change at their institutions. Um, but when you look at what we ranked for, it's a bit of a mixed bag. Like innovation, so research and patents, that's good. We're taking, they're actually doing fundamental research. Ventures and ecosystem, kind of surprised there, but it indicates that they, relatively speaking, to other big banks, seem to be working with the local ecosystem, and so those are all net positives.
Yeah.
Transparency, I'll take it. What surprised me, and this is where it gets probably where you get some of the negative from the tech ecosystem, is to see
Hmm.
them lagging in talent and leadership. Like lots of the talent is coming out of our academic institutions across Canada. Our banks should have an advantage at grabbing real and great talent, and the fact that they're not leading for financial institutions uh, may indicate that this talent's either staying in academia, deciding to work at startups, or being lured to U.S. financial institutions who may pay more. So that's a bit disappointing. And then
Okay.
leadership, well, we love to see more leadership. Let's just put it that way.
Okay. And just last question before we move on. You mentioned just it's always good to see them take advantage of the ecosystem, but is there anything else to highlight, or why this might be important for us to
Look,
share?
if they're really working with the local ecosystem and may present local startups with the ability to work with large Fortune 500 companies and provide validation before they go sell abroad, um, if you're lucky, it may lead to better products and solutions for startups themselves. Look, I'm an optimist by nature, and I'm hoping that if the banks are investing in AI, we'll see it in better solutions for the Canadians.
Nice. And I know we're kind of zooming through everything a little bit, and we've kind of started with some finance news, and we're also ending with something similar as well, a little bit of a sandwich in a sense with this episode. So just one more notable, I guess, or a notable raise that we want to be discussing. This one is notable for a few reasons, but if you can just share what the news is first before we get into that.
And this one sort of is counter to everything else we talked about so far. So last week, maybe it was this weekend, Deep Sky announced it raised $57.5 million from Brightspark Ventures, Whitecap Venture Partners, Investment Quebec, BDC Capital Nomers. So a large round led by lots of Canadian financial VCs and financial institutions.
And I was not familiar with Deep Sky at all. Are they late stage? I guess where would they fall?
No,
they are.
Deep Sky is a pre-product climate tech startup.
And okay, so then now another question. So given that they are pre-product, how are they able to raise so much? Is just like a huge question mark for me.
Mix of several things. It's co-founded by Fred Lalonde. He's the founder of Hopper, which is a multi-time unicorn. When you make money from investors, they're likely to back you again. The former VC head at Omers, Damien Steele, left his position to be the CEO of Deep Sky. So that's a strong endorsement from an investor. They're focused on carbon capture. If it works, it's a massive opportunity, and there's strong market tailwinds.
Okay.
So you got credible founder, credible CEO, massive market, and this needs significant capital to get off the ground. So you can't drip $500,000, $2 million. This actually requires this amount of capital. So market size, the team, and the requirement for capital that all mix together say, hey, we need like 60 million plus. And they raised 17 million earlier in the year too. So you're not talking about 60 plus to just basically be to get towards hopefully a product.
Right. And I know you kind of touched on what they do. Is there any more detail that you can share just to help people maybe understand why just this kind of capital would be needed?
Okay. So Deep Sky is capturing carbon from the sky and ocean using reactors developed by other companies. It stores the carbon underground and makes revenue by selling carbon credits on carbon exchanges. Each location they build will require 500 to 600 million to build. Sorry, 500 to 800 million to build.
Okay.
Sorry, not used to those big numbers.
No, that's okay. And those are big numbers, which I guess my next question then is, 500 to 800 million is a lot of money. So how will they have the capital it needs to build, these locations? Because that's crazy.
Alex, I thought you were going to fund it. Don't you have that money lying around?
No, unfortunately not. I think we'd be doing bigger things with the podcast if I did.
Yeah. So Deep Sky is hoping to raise funds from government agencies and crown corporations, and appears to be using the funds it has raised to date to build a small-scale demonstration facility to prove that the technology it's using works and show what a full-scale location will look like.
Okay. So you mentioned like having to prove that the technology it's using will work, and then also what the full-scale location will look like. So it sounds to me like a few things have to align in order for this to work. So what has to go right in this case for it to work?
First, the way it's going to make revenues is by selling carbon credits.
Right.
So there's a couple things. Carbon credits are all based on age, and they trade by exchanges. And so the idea with a carbon credit is, hey, if we're polluting too much, we'll not get penalized if we buy carbon credits from people that don't pollute that much. So the problem right now is the exchanges have way too much supply, not enough demand. And it's not clear how many different cohorts or vintages of carbon credits will this be going on. Like, will there be new carbon credits every 3 years? Will the exchanges start making positive? So right now, to make revenue, the carbon credits have to be worth something and tradable. Right. Second thing is the underlying technology is all new. It's all I think they're talking like 10 different suppliers. It has to work, and then you have to find a way to scale it up because right now these are all made by hand. Second of all, or third of all, I guess, you've got a company that's using other people's technology to build a business, which is, how lots of businesses are done, but not usually what you see in venture. So but they're betting that economies of scale is a huge competitive edge or moat. That, as a technology, because the IP is not there. So what they're saying is, hey, hopefully prove this out. We can go raise money faster than everyone else, and then, building these at, building multiple locations, spending $800 million. It's not easy for people to copy us. So we'll have a market which we can actually make returns on. So you need 2 or 3 things to go really well. Actually, you need all 3 things to go well. Otherwise, you're in trouble.
Yeah, and obviously a lot of risk in terms of being an investor or in something like this. Of course, it's something I think people should have on their radar more, and more investment should be made in technology like this. But it definitely represents a gap, I think, that we're seeing in terms of what's being built and what's being created. Do you have any other final takeaways for our community? This is obviously very unique from what we're used to talking about.
Look, first of all, this goes kind of where the markets are. We say the markets aren't being bold or investing in big dollars. Here's a big bet or big investment. I also think VC, especially in Canada, gets criticized for being timid with it when invest in the known. The saying is like, we're expecting flying cars and all we got was Twitter. Well, here's VCs investing in something that they supposedly should. It's capital intensive, but has high margins if it works. It's unproven technology, but there's a big market to be unlocked. It creates value for the world and investors if it works. So, hey, this is what supposedly venture capital should be doing. So kudos to investors and the founders. It shows there's an appetite for capital intensive startups if there's a massive market, a proven executive team, and regulatory backing, because there's definitely regulatory tailwinds. But again, this is not a playbook I would recommend for most startups in Canada. None of this would be possible if Fred from Hopper was not as successful as he had been. Investors are willing to take risk when they're playing with house money. Hypothetically, he's made lots of money for his investors in Hopper. So this is, they're taking some of the money and recycling it in him, and trust that Fred will be able to make this all work.
And I think those are also good points to highlight, because it is a unique deal in terms of, it is pre-product. There's a lot that has to go right for, I guess, all of this to work. But very interesting. I don't really think we've talked, or I don't even know if we've talked at all about something like this year. I'd have to go back and look. But so just before I let you go, we're winding down the year. So our in-person events at TechTO have concluded, but our 2024 calendar is starting to fill up. So a couple of events just to highlight before we jump off. So January 15th, we're back at 111 for our first TechTO Together of the year. And also February 12th, we are back at Rotman. So those events have been really popular. We've had, again, we're starting to announce more of our speakers for these. So just keep an eye on the website for more updates. And end of this month, we have an insider event at Othership, which will be very cool. So if you don't know what our insiders program is, you can also find out on our website and check out Othership's new location, which will be very cool. Any last highlights from your end before we go?
Look, I think there's a couple things going on next few weeks as we close down for the year. If you're around and you can make them, and I think the Othership thing's gonna be cool. Unfortunately, I'll be in the Bay Area. You guys see Jason, which is probably better. I think the next 4 weeks are going to be a sprint for most founders, and then they should take time to recharge, because I think 2024 is going to be a year that great things happen, but it's not going to be any easier than this year. So I'm always impressed by founders and their teams building stuff, and we'll probably have a couple more of these before the end of the year, but just want to remind people, hey, we do this because we appreciate the ecosystem.
We do. And we're very excited to talk about, the challenges and also the wins, of course. That being said, I know we're trying to put together a trends list or hot topics for 2024. So if there's anything you as a listener or as just someone who's interested in tech wants to hear us talk about, or something you have on your radar, please share with us. Love to hear what you're most interested in learning about or hearing us talk about for 2024. Alex, thank you again for helping us break everything down. If you enjoyed today's episode, don't forget to like and subscribe wherever you're watching or listening. And we will be dropping a new episode of TechTO Quick Takes next week.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be in the next multi-billion-dollar idea. So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.